Today we are talking about superannuation. Are you being scammed? Thanks to everyone joining me out there today. For those of you that don't know me, my name's Angela. I started the Money Messenger project as a way of imparting some of my knowledge about financial planning. I've been working in financial planning for the last 20 years, learned a thing or two about money. I'm an investor myself, so everything I teach you in these videos, I do myself as well. So I'm imparting to you some of my knowledge that I've learned in my career so far. Today, I wanted to talk about superannuation. There's a lot of talk at the moment in the press about superannuation, financial planning, financial products, Commonwealth Bank, AMP Bank, because there's a Royal Commission out at the moment and it's investigating different financial products, a lot of banks and what they're up to with regards to charging fees to clients, and that's just a small part of it. So I wanted to talk about superannuation because it's a huge part of our lives, yet a lot of people don't pay too much attention to it. Is superannuation a scam? Flat answer is no, it's not. And don't let anyone tell you it is. Superannuation is actually one of the most tax-effective investments you can make. The reason that there are a lot of benefits behind it is because it's a government scheme and the government wants you to save for your retirement. So in turn for that, they offer you some tax benefits, tax concessions, and some benefits to motivate you to save. Because back in the day, when we retired, the government would take care of us with an age pension. But unfortunately, there's a lot of baby boomers who were all born around the same time post-war. They're all retiring now around the same time, and it's causing some pressure on the pension system. So what the government thought is that for future generations, people like myself, for example, you're going to be lucky if there is an age pension at all around by the time we get to 65. Not only that, but the government is extending the retirement age in Australia. It's now pushing up to 67. So no longer should you be relying on the government to take care of you in retirement. And actually the age pension is quite low. It's only a few $100s per week. So depending what sort of lifestyle you want in retirement, but if you've worked your entire life and then you want to live poor in retirement on only a few $100s a week, and there's a lot of pensions out there struggling, then rely on the age pension. But if you don't, you need to maximize your superannuation or other investments. See, the thing about superannuation is, like I mentioned, it is one of the most tax-effective investments you can make. For the benefit of you putting money into your superannuation fund, it's only taxed at 15%, the earnings, for example, whereas if you invest money in your own name, in shares or property or whatnot, the money you make from that is taxed at your marginal tax rate, which can be a lot higher. For most people, if you're earning, say, 40, 50, 60 grand upwards, you might be at the 32.5% bracket, or you might be at the 45% tax bracket. So it's a big difference compared to 15% in super. Also, once you get to 60 and you start drawing an income from your superannuation, the income you draw and the money you withdraw, say lump sums, it's completely tax-free. So those benefits are there to entice you to build your superannuation. So no, superannuation is not a scam. It's one of the most tax-effective investments you can make. The thing with superannuation that concerns some people is that the government changes their mind quite often with regards to superannuation and how much you can contribute to superannuation, when you can access your superannuation. So some people lose confidence in the superannuation system because the government changes. Every time a new government comes in, they like to play around with the figures. Either they think people are putting in too much money, or certain types of people are putting in too much money. They may want to change the tax rates, the amounts you can put in, that type of thing. But the good thing is, with financial planners, when you find a financial planner that is good at their job, they provide you with strategic advice. And a lot of it does focus around superannuation, because there are a lot of rules and regulations and thresholds you need to know about. So when you find a good financial planner that looks after you with a strategic plan, they will help you to maximize your superannuation using whatever superannuation rules, thresholds, amounts are available at the time. So don't be scared of superannuation just because rules change now and again, or the contribution amounts change now and again. There's ways around it, and it's a very good investment to maximize. For example, if you put in your superannuation as a young person, if you put, say, like $25 a week into superannuation, throughout your entire life, because of the tax benefits that you can claim by salary sacrificing a small amount, you can find that by the time you come up to retirement age, you could have even another $90,000 in your superannuation fund. Even though if you calculate the numbers after tax and all the benefits, you might have only put in about $43,000 yourself. So it does pay to add a small amount to your superannuation, even if you're young and got many years to go before retirement. Superannuation is a good side investment to have. It shouldn't replace all of your investments because you can't access superannuation until you're retired. So for example, for someone my age group, I can't really access superannuation until I'm around 60. So I don't want to tie up all my money into superannuation. Let's talk about the scam side of superannuation though. And it's not superannuation as a whole. It's some of the superannuation products that are out there. It's also the lack of interest from a lot of people with regards to their superannuation. That's when the scam comes into place. And it's not an intentional scam, but the fact is when you ignore something and it just goes by the wayside, that's when money starts to get wasted, and that's when there's issues with superannuation. Every day, the combined savings of millions of Australians are bleeding out thousands and thousands of dollars in wasted money. And that's mainly from having duplicate superannuation funds with duplicate fees and also duplicated insurances in a lot of those funds. See, when you join an employer and they start a superannuation fund for you, you can use your own superannuation fund that you might have had from a previous employer. But if you don't have one already, or you don't tell your employer, then they're going to open up a superannuation fund for you because they have to. They have to contribute 9.5% of your salary to super every year. Now, that 9.5%, that's not deducted from your salary. Don't let anyone tell you it is. Quite often when you go for a job and somebody says your salary package is $70,000 including super, that means that, you know, a portion of that is superannuation and a portion of it is your salary. The fact is that that 9.5% super guarantee contribution is paid on top of your salary. When the employer opens up the superannuation fund for you, they will ask you if you already have a superannuation fund, but it's up to you to tell them you have one. So if you didn't pay attention to the last job you held, which super fund was being used for you, that's when you can start to get multiple super funds opened up for you, depending on how often you change your employer. With superannuation these days as well, you're allocated a certain percentage, a certain amount of insurance in your superannuation fund. There's usually 3 different types of insurances: life insurance, which pays out if you pass away; total and permanent disability insurance, or TPD, that's paid out if you are seriously hurt and unlikely ever to return to work again. And there'll be some income protection insurance, or sometimes called salary continuance insurance. That pays a monthly amount if you're unable to return to work because you're sick or injured for a shorter period of time, but with the intention of returning back to work. Now, the reason these insurances are provided is because back in the day, we used to have one super fund for life, essentially, because we had one job for life. But that's no longer the case. A lot of people don't keep the same job for their working life, and so they move around from employer to employer. But back then, when superannuation was started, the unions pushed to have a better deal for all employees. That meant insurance, cheap insurance, bulk priced group insurance. If it's offered to all the people in a superannuation fund, some healthy, some not healthy, the insurer will provide a cheaper premium so that all members benefit from the insurance, even though all of them won't necessarily have to claim the insurance. So the unions push to have insurance attached to most superannuation funds. So when you join a fund, you'll be allocated a small amount of life insurance, TPD insurance, and usually some income protection insurance. And that's based on 75% of your income. The problem being with that, though, is that a lot of people have superannuation funds now with insurances attached to each of them, and they either don't opt out of the insurance cover, which you can cancel it, or they don't even know they've got the cover, because a lot of people, unfortunately, they don't look at their superannuation statements. They may not even know what superannuation funds they have. They maybe don't care about superannuation, so it's not really at the forefront of people's minds. But the thing is, though, if you've got superannuation insurance attached to your fund and you've got premiums of $200, $300, $400 a year, right up to $2,000 or $3,000 a year coming out of your fund, depending how old you are and what type of cover you have, that eats into your retirement savings a lot. So by having multiple superannuation funds, not only are you being charged multiple fees, as in most superannuation funds have like a policy fee attached to them, could be $50, could be $78, $90. If you've got 2 or 3 funds already, you're paying 2 or 3 more of those fees than you should. Doesn't seem like a lot, but it really does add up over time. Just like if you put away $25 a week into your super fund every week until retirement, that will make a huge difference in the balance. Likewise, if you're losing $200 or $300 a year in extra fees, or $300 or $400 or $500 a year in extra insurance premiums, that's going to make a huge difference to your retirement savings balance. You're going to be behind the 8 ball compared to someone else who has one superannuation fund with one set of fees and just enough insurance to cover their needs. So it's important to go and check your superannuation funds and find out what you've got in there. Particularly within income protection, you can claim you're eligible for 75% of your income as an income protection benefit. But if you have income protection insurance in, say, 2 funds that you have, you might have more insurance than what you're actually even eligible to claim. So that means you might be paying insurance premiums for insurance that you're never going to receive, ever, even in the event of a claim. For example, take someone who earns $50,000 a year. They're entitled to 75% income protection, which equals $3,125 per week. That's the sum assured that they can be insured for. But I quite regularly see people that have 2 or 3 super funds. What if you were allocated, say, $2,000 worth of income protection in 2 of your funds? That means you've got now income protection totaling $4,000 across your super funds. But if you only earn $50,000, you would never be eligible to claim the full $4,000. If you ever go on claim, you'll be asked what other insurances you have, and the insurers will work together to pay you the balance that you're owed and no more. So you would essentially miss out on $875 worth of income protection benefits that you've been paying for the whole time, but you're not eligible to claim. So not only is it important to watch how much you're paying in insurance premiums, but to make sure you've actually got the cover that you're eligible to claim one day. The fact is, when you've got 2 superannuation funds paying 2 different fees, paying different insurance premiums, that type of thing, you are going to be behind the 8 ball, like I mentioned, when it comes to retirement. There's a productivity commission that came out recently that said for the average person that has 2 superannuation funds, they will be approximately 6% worse off by retirement compared to someone that has just 1 fund. And that means missing about $51,000 worth of retirement benefits, right up to about $125,000 worth of benefits. So it's a huge difference that these small amounts can make to your end result. Steps to take so you're not being scammed by super and so you're not missing out. Number 1, take your fund, your super fund that you have now, if you have one and you change employer, take it with you. It's okay to take an existing fund to a new employer. Most people have choice of funds for superannuation these days, and you can take your old fund with you. The only time you can't is if perhaps you're part of your previous employer's superannuation fund plan. Then that plan will change to a personal plan with some changes to the fees and whatnot. Then you can take that plan with you, or you can choose to open up another one and roll over your old fund to the new one. Look out for lost super. If it takes you ringing up past employers to find out what superannuation fund they used whilst you were working for them, then that's what you need to do. Think about the past employers that you've had in the past, find out which super fund they use. Also, contact the Australian Tax Office through the MyGov website, and they will also list for you any lost superannuation monies that they may have found over the years. Look to consolidate your super. Find out what funds you have and look to move them all into one fund. We hear that a lot, but what does it mean? It means contacting each fund, filling out paperwork, selecting one fund to roll them into, and voila. If you're not sure which fund you should pick as your main fund, seek financial advice from a financial advisor, or at least ring up your super funds to have a chat to them. A lot of them can't give financial advice though, That's why financial planners are around. The important part before you roll any superannuation fund though is to check if there's any exit fees. Usually a lot of funds charge 20, 30, 50 bucks to close them. But some older insurance policies, superannuation funds, can have quite sizable exit fees. So that's something to keep in mind. But for the most part, newer funds of today, they don't really have big exit fees, maybe 20, 30 bucks like that. But check if there's any insurances attached to those existing funds. Because if you roll over a super fund to another fund, you will lose the attached insurance. That means if you've had any changes to your health or you're unable to apply for new insurance, you might leave yourself uninsured, which can be devastating, particularly if you have had changes to your health. So you need to check the insurances first. And if so, replace those first before you lose the current insurance. The caveat to that, what I just mentioned about rolling over super funds, sometimes you have to have more than one fund. It's not ideal, but sometimes, particularly in financial planning, when you go and see a financial planner, they may recommend you to keep an existing super fund. And that often is because of the insurances attached. Perhaps they might be quite competitively priced, or perhaps you might have a problem with your health and are ineligible for new insurance. So there can be times where having more than one super fund is advisable, but generally then you would still only have two funds, not 3 or 4 or 5 like I see with some people in financial planning. So if unsure, seek advice. Superannuation is a complex area and there's more to worry about rather than just the fees of your fund and how you're invested. There's other things to consider. So if you're unsure, seek advice from a financial planner. Note to the video today, with all of these videos, these are not personal financial advice. This is financial education. So it's up to you to take what I'm saying as research, information, look into yourself before you proceed with anything. You need to check your fund and insurances. Don't just go and close them all and roll into one. If you'd like to hear more about these videos, tune in every Wednesday. I do new videos on various types of money issues out there. Please comment in the box for topics that you'd like to hear more about, and I'm happy to do videos in the future for you. And thank you very much for watching. Please don't forget to subscribe to the Money Messenger website, www.moneymessenger.com, and I will see you all next week.